Welcome back, everyone. Let's talk about the caselet 5 now, and I'll give you guys a minute to take a look at what is there on your screen before I move on. Okay, so let's say you are a lender, right? You are in the business of lending money to others, and here is a potential loan that you can give to a customer, right? So the loan amount is $200,000. The duration is 12 months. It's exactly the same loan term and conditions that we've talked about in the previous caselet, right? And the cost of borrowing, that means the money that you are actually lending, you are borrowing this amount from the internal or external stakeholders or treasury at 5%, and you're going to lend this amount to the customer at 15%. The question that we have to answer is, shall we move forward with this idea or this particular loan configuration? Does it really make sense financially to have this loan issued, right? Now, can you think about what this idea is all about? What is the name of the metric that will be used to really ascertain whether we should move forward with this loan, or for that matter, with any project financially? All right. The name of this financial concept or the metric is very, very important metric, and it's a combination of two, but we'll focus more on the NPV, and that is the net present value. And it builds further on the concept of the future money, and that you have to discount it and you have to bring it back to the current value, and then you can evaluate how much is the gain that you're going to have overall in this business proposal, right? And a related concept is called IRR, that is the internal rate of return. And the rule of thumb is that if you're evaluating any project, the NPV of that project should be more than zero. That you are not going to lose the money in the process. Actually, you're going to be net positive, and it should be as high as possible, right? Similarly, the IRR should be as high as possible, but at a bare minimum, that should be equal to the discount rate that you're gonna have, right? So in this case, we have a discount rate of 5%. So if the project is gonna be viable, I should be looking at an IRR of more than 5%, right? So that's the basic concept. But for now, ignore the IRR part, just focus on the NPV and make sure that you're able to follow me in this particular calculation. So let's just go and take a look at the article very quickly. So again, this is a LinkedIn article that I've typed some time back, and over here we are working with this fictitious bank, XYZ Bank, and again the same problem that we're looking at. You can ignore the loan origination fee as well. So what does the bank do? Bank is in the business of giving the money to the customer, and the customer is gonna pay back over a period of time, right? Cash flow is nothing but your EMIs that are gonna come in on this loan over a period of time. Discounted cash flow, if you remember in the previous discussion, we talked about that the future value of money and the present value of money. So the money that is coming in the future is gonna be valued less at the present of time, and we have to discount that cash flow. Similarly, we have talked about the EMI and how do we calculate the EMI. This article focuses on doing the calculation in Excel, but we don't have to worry about that. We can do that in R very, very quickly. And the concept which is going to be new for you is the NPV. So let me spend a minute talking about the net present value. For those who always like to look at the mathematical formula, I have typed it over here. So this is your initial outlay of the investment. Then you're going to have cash coming in the future, and you're discounting the cash coming in by the discount rate, right? So something that is coming in the first year will have, let's say, $100 coming in the first year, with the 5% discount will be 0.05. Similarly, the next $100 coming in will be 100 divided by 1 plus 0.5 square. So the discounting is going to be heavier and heavier for the future cash flow. You do not have to do this manually. All of this can be done in an automated way, but you should be aware of the concept in terms of how exactly this happens, right? And an easier way to remember that is that a bird in hand is worth two in the bush. So the same $100 that you have now is much higher than the $100 that you're gonna have 1 year down the road or 2 years down the road, right? So that's the main concept behind that. So we talked about the IRR as well. So IRR should be more than at least the cost of capital or the discount rate that you're looking at. But IRR is a little bit tricky concept, so we'll hold it off for a different discussion on a different day. But at least you should be aware of how the NPV calculation really works out, right? This is a very detailed view in terms of all the things which are laid out over here. Again, as I said, you don't have to worry about the calculation right now. This is all done in Excel, but you can see exactly how the cash will be coming in on this loan. $200,000 originated and 12 months of collection, and we have 18